There is a single calculation that underpins every great fortune. It is not complex. It does not require a supercomputer or a doctorate in mathematics. But it is the most important calculation any person, any entrepreneur, any investor will ever make. It is the final promise you make to yourself before you risk a single dollar of your hard-earned capital. It is the foundational law for avoiding catastrophe, a law practiced with religious devotion by the most successful investor in history, Warren Buffett. This law, this simple yet profound idea, is called the margin of safety. And understanding it, truly internalizing it, is the difference between a lifetime of anxiety-ridden speculation and a lifetime of sleeping soundly while your wealth compounds inexorably, protected by an invisible fortress. Most of the financial world is obsessed with a single question: how much can I make? They chase the dizzying upside, the next 100-bagger, the disruptive technology that will change the world. Their analysis is a monument to optimism, a forecast of all the things that could go right. Buffett begins with a different question, a question born from the harsh lessons of the Great Depression, a question that reoranges every subsequent calculation: how much can I not lose? This is not semantics, it is a tectonic shift in perspective. It is the realization that the secret to winning the long game is not about hitting home runs. It is about rigorously, systematically, and ruthlessly avoiding the strikeout that takes you out of the game permanently. The margin of safety is the architecture of that avoidance. It is the bedrock of all value investing, the central nervous system of Buffett's entire philosophy. It is the deliberate act of building a massive, unreachable buffer between the price you pay for an asset and its real, underlying worth. This buffer, this gap, this margin, is not for generating extra profit. That is a happy byproduct. Its primary purpose is to be a shock absorber for a future that is, and will always be, unknowable. It is your protection against a world filled with bad luck, bad timing, analytical errors, and the devastating consequences of your own human fallibility. It is the financial equivalent of an engineer building a bridge to withstand 10 times the maximum expected load. Not because he expects a parade of 10,000 elephants, but because he knows that bridges sometimes face forces that no one, no matter how brilliant, could ever have predicted. Today, we are not just going to talk about this principle. We are going to deconstruct it, piece by piece. We will journey back in time to understand its origins. We will dissect the psychological demons it is designed to conquer. We will build the practical blueprints for applying it to your own decisions. And we will witness the catastrophic consequences for those who ignore it. This is not another fleeting stock tip. This is a permanent upgrade to your mental software, a lesson in financial security that will serve you for the rest of your life. This is the first and final promise of intelligent investing. The most powerful ideas in finance are rarely born in the sterile environment of a university classroom. They are forged in the crucible of crisis, hammered into shape on the anvil of catastrophic loss. The concept of the margin of safety, the intellectual shield Warren Buffett would later wield to build his empire, was not an academic theory. It was a survival mechanism, conceived by a man who had stared into the abyss of the Great Depression and learned its lessons in the most brutal way possible. That man was Benjamin Graham, the dean of value investing and the single most important influence on Buffett's life. To understand the margin of safety, we must first understand the world that created Graham, and the single investment that perfectly encapsulates his philosophy. The story begins not in Omaha, but in the smoke-filled boardrooms and chaotic trading floors of 1920s New York. Graham was a brilliant analyst, a rising star at a brokerage firm, making a fortune in the roaring bull market. But then came 1929. The crash and the ensuing depression didn't just wipe out his clients. It nearly wiped out Graham himself. He lost almost everything. But for a mind like Graham's, this personal disaster was also a priceless education. He saw firsthand how the speculative fervor, the obsession with earnings projections and growth stories, had led an entire generation of investors to ruin. He saw that the market was not a rational weighing machine, but a manic depressive voting machine, swinging violently between irrational exuberance and unjustified pessimism. He dedicated his life to creating a system, a set of rules for investment strategy that would protect an investor from both the market's madness and, more importantly, from their own emotional failings. The cornerstone of this system was the margin of safety. His search was for investments so cheap, so demonstrably undervalued, that success was almost a mathematical certainty, regardless of what the broader economy or the stock market did. This quest led him to one of the most elegant and illustrative investments of his career, the Northern Pipeline Company. In the years following the crash, Northern Pipeline was what the market considered a dead business. It was part of the old Standard Oil monopoly that had been broken up, and its primary business of transporting oil from the Midwest to the East Coast was in decline. The narrative was simple. Pipelines are old technology, their volumes are shrinking, the future is bleak. The stock was languishing, ignored and despised by Wall Street. But Benjamin Graham had trained himself to do something most investors find impossible. He ignored the story and read the financial statements. And what he found there was astounding. He performed a simple financial analysis. He looked at the company's balance sheet, the driest and most boring of all corporate documents. On the asset side, he found a treasure trove. The company, as a legacy of its past monopoly status, had been forced to hold a massive portfolio of high-quality railroad bonds. It also had a substantial amount of cash. Graham meticulously added up the value of these liquid assets, the cash and the bonds. Then he looked at the other side of the ledger, the liabilities. The company had almost no debt. He subtracted the total liabilities from the value of just the cash and the bond portfolio. The number he arrived at was $65 per share. This figure represented the company's net liquid asset value. It was the amount of cold, hard cash an owner would receive for each share if the business were to shut its doors that very day, sell its bonds, and pay off all its debts. It didn't even include the value of the actual pipeline, the buildings, or the land. Now for the astonishing part. At the time Graham was doing this analysis, the stock of Northern Pipeline Company was trading on the stock market for a price of $65 per share. Think about that. By purchasing a share of the company, you were effectively paying $65 to receive $65 in cash and high-quality bonds, and you got the entire pipeline business, the pipes, the pumps, the real estate, everything, for free. This was the margin of safety in its purest, most undeniable form. Graham didn't need to predict the future of the oil industry. He didn't need to forecast the company's earnings. He didn't need to know if management was brilliant or incompetent. The success of the investment was not dependent on anything going right. The value was right there, on the balance sheet in black and white. His capital preservation was virtually guaranteed. He began buying the stock for his investment partnership, and as the price dipped further into the 50s amidst the general market gloom, he bought even more. The market, in its pessimism, was offering him a dollar bill for 50 cents. He simply took the deal. The outcome was as inevitable as gravity. Eventually, other investors recognized the absurdity of the situation, and the company's management itself began to distribute the excess capital to shareholders. Graham and his partners made a handsome, low-risk profit. This single story became the blueprint for Warren Buffett. When Buffett read Graham's book, The Intelligent Investor, as a young man at Columbia University, it was as if the heavens opened. He described it as finding a roadmap. The Northern Pipeline story was not just an anecdote. It was a revelation. It taught him that a stock is not a lottery ticket, it is a fractional ownership of a business. It taught him that the market is there to serve you, not to instruct you, offering up irrational prices for you to exploit. And most importantly, it taught him that the foundation of building wealth is an obsessive focus on what a business is worth, independent of its price, and then demanding a discount so large that it protects you from the unpredictable storms of the financial world. This intellectual inheritance from Graham was the first pillar in the cathedral of Berkshire Hathaway. The genius of Benjamin Graham's margin of safety is that it's not just a financial calculation, it's a powerful psychological weapon. It's a preemptive strike against the flawed wiring of the human brain, which is spectacularly ill-suited for making rational, long-term investment decisions. Our minds evolved on the African savanna, where spotting a predator in the grass, reacting instantly to vivid, immediate threats, was far more important than calculating the long-term yield of a fruit tree. This ancient wiring manifests today as a series of cognitive biases that lead the vast majority of investors to financial ruin. The story of Northern Pipeline is a perfect illustration of two of the most powerful biases: the narrative fallacy and anchoring bias. The narrative fallacy, a term coined by Nassim Taleb, describes our deep-seated need to fit complex facts into a simple, coherent story. We are storytelling creatures. A good story is emotionally resonant, easy to remember, and simple to pass on. The story of Northern Pipeline in the 1930s was a simple one. It's a dying business in a declining industry. This narrative was easy to grasp and felt intuitively correct. Once that story took hold, it became the lens through which all new information was filtered. Shrinking oil volumes? Confirms the story. A pessimistic analyst report? Confirms the story. The stock price going down? Confirms the story. The brain loves these simple narratives because they reduce the mental effort required to process a complex reality. The alternative, painstakingly reading a balance sheet, understanding bond portfolios, calculating liquidation value, is difficult, boring, and lacks the emotional punch of a good tale. Graham's superpower was his ability to completely disregard the narrative. He didn't care about the story, he only cared about the numbers. He was looking for facts, not fiction. He understood that compelling narratives are the most expensive things an investor can buy in the stock market. The second bias at play was anchoring. This is our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. For investors in Northern Pipeline, the anchor was the declining stock price and the narrative of a dying business. Every subsequent judgment was unconsciously benchmarked against this initial negative impression. It's like haggling in a bazaar. If the seller's first price for a rug is $1,000, you're unlikely to end up paying $50, even if that's its true worth. Your mind is anchored to that high initial number. The market saw a $65 stock and its primary thought was, this business is in trouble. Graham came to it with no anchor. His anchor was his own calculation of the liquidation value, $65 per share in cash and bonds. His entire perspective was anchored to value, not price. He saw a $65 stock and his thought was, I am paying nothing for a functioning business. This is a profoundly different starting point, and it leads to a profoundly different outcome. The margin of safety is the tool that forces this shift in perspective. It forces you to ignore the seductive story and the prevailing market price. It makes you do the hard work of building your own anchor based on a conservative assessment of reality. This is why the principle is so crucial. It acts as a buffer not just against financial loss but against your own psychological weaknesses. When you demand a 50% discount to intrinsic value, you are explicitly stating, I know that my forecasts are probably wrong. I know that I am susceptible to emotional narratives. I know that I might be anchored to flawed information. This massive discount is my protection against my own humanity. It is an act of profound intellectual humility, and in the world of investing, humility is a far greater asset than genius. The theory of the margin of safety is elegant, but for it to be useful, it must be translated into a practical, repeatable process. It requires a blueprint. While Benjamin Graham's world of net nets, companies trading for less than their net current assets, is harder to find today, the underlying mental model of asset-based valuation is timeless. It is the most fundamental way to build your own anchor of value, and it's a skill every serious participant in the world of financial planning or private equity must understand. Here is a step-by-step guide to applying this foundational mental model, the kind of basic financial analysis that can protect you from devastating errors. Let's call it the blueprint for finding a liquidation value floor. Step 1 is the simplest, yet most overlooked. Obtain the company's most recent balance sheet. This is publicly available for any listed company, found in their annual 10K or quarterly 10Q reports. Think of the balance sheet as an X-ray of the business at a single moment in time. It lists everything the company owns, assets, and everything it owes, liabilities. Your job is to play the role of a conservative, even pessimistic liquidator. Step 2. Focus on the current assets. This is the section that includes things that are already cash or can be converted into cash within a year. You'll see line items like cash and cash equivalents. You can value this at 100% or $1 for $1. Next, you'll see accounts receivable, which is money owed to the company by its customers. A conservative analyst would never value this at 100%. Some customers will default, so you apply a discount. For a stable business with high-quality customers, maybe you value it at 90 cents on the dollar. For a shakier business, perhaps you'd only value it at 70 cents. Then comes inventory. This is the trickiest part. A software company's inventory might be worthless, while a real estate company's inventory of land might be very valuable. You must be brutal here. How much could you get for this stuff in a fire sale? For a retailer with fashion goods, maybe only 25 cents on the dollar. For a commodity producer, perhaps 60 cents. The key is to be consistently pessimistic. Step 3. Move to the long-term assets, but with extreme caution. This section includes property, plant, and equipment, PP&E. Again, you must be a ruthless liquidator. An office building in Midtown Manhattan has significant value. A highly specialized factory machine for a niche product might be worth only its value as scrap metal. A good rule of thumb is to take the stated book value of PP&E and apply a very heavy discount, perhaps valuing it at only 20 to 50% of what the company claims it's worth. Ignore intangible assets like goodwill completely. In a liquidation, goodwill is almost always worth zero. Step 4. Now, turn your attention to the liabilities side of the balance sheet. This part is easy. You subtract 100% of all liabilities. From short-term debts and accounts payable to long-term bonds and pension obligations. Everything. When you owe money, the creditor expects to be paid in full. There are no discounts here. Step 5 is the moment of truth. You take your conservatively calculated value of all assets and subtract the full value of all liabilities. The number you are left with is your estimate of the company's private liquidation value. You then divide this number by the number of shares outstanding to get a liquidation value per share. This is your anchor. This is your number, based not on stories or forecasts, but on the cold hard reality of the business's assets. The final step is to compare your calculated liquidation value per share to the current market price of the stock. Is the stock trading at a significant discount to your number? If your conservative liquidation value is $50 per share and the stock is trading at $25, you have found a potential 50% margin of safety. This process is the direct antidote to the narrative-driven speculation that ruins most investors. It forces discipline. It forces conservatism. It forces you to ground your investment strategy in tangible reality. For entrepreneurs, this same thinking is critical. Understanding the liquidation value of your own business provides a crucial baseline for any executive decision-making. From raising capital to considering a sale, it tells you what the business is worth in a worst-case scenario, which is the most important calculation for ensuring long-term financial security. To truly appreciate the wisdom of a principle, you must study the wreckage created by its absence. The antithesis of the margin of safety is not just a different strategy. It is a fundamentally different and far more popular worldview. It is the path of the 99%, a path paved with exciting stories, intoxicating optimism, and eventually, financial devastation. This is the path of chasing narratives. And there is no greater example of this folly in modern history than the dot-com bubble of the late 1990s. The narrative of the dot-com era was one of the most powerful and seductive in history. The story was that the internet was changing everything. It was a new economy where the old rules of business, profits, assets, cash flow no longer applied. The only thing that mattered was growth. growth in eyeballs, growth in clicks, growth in mind share. Companies were not valued on what they owned or what they earned, but on the grandeur of their vision and their ability to capture a piece of this new digital frontier. It was an era that celebrated burning cash as a sign of ambition, not of a flawed business model. Let's examine a classic case study from this era, Pets.com. The company had a simple, and at the time, revolutionary idea: sell pet supplies online and deliver them to people's homes. They had a catchy name, a memorable sock puppet mascot that even appeared in the Super Bowl, and a story that was incredibly easy to understand and believe in. They were going to be the Amazon of pet food. Investors, both professional and amateur, fell in love with the narrative. They poured hundreds of millions of dollars into the company. In early 2000, Pets.com went public. On the day of its IPO, the stock soared, and the company was valued at over $300 million. Now, let's apply the margin of safety lens. What would a Ben Graham-style analyst have seen? They would have ignored the sock puppet and the Super Bowl ad. They would have opened the company's financial statements. On the asset side, they would have found very little: some cash, which was being spent at an alarming rate, some inventory of pet food, and some computer servers. There were no valuable factories, no real estate, no significant tangible assets. On the liability side, they would have seen growing debts. But the most important document would have been the income statement. It would have shown that for every dollar of pet food the company sold, it was spending roughly $3 on marketing and shipping. The business model was fundamentally, catastrophically broken. They were losing money on every single sale. An investor demanding a margin of safety would have calculated the liquidation value of Pets.com as being close to zero, or perhaps even negative. They would have seen a business with a wonderful story but with no substance, no moat, and no path to profitability. The market price of over $300 million was not anchored to any reality. It was floating on pure, unadulterated hope. The 99% of investors who bought into the narrative were paying a premium for a story, not buying a business at a discount. They had no margin of safety. In fact, they had a margin of danger. The outcome was as predictable as it was swift. The narrative could only sustain the stock price for so long. The relentless cash burn continued. Less than a year after its celebrated IPO, Pets.com declared bankruptcy and ceased operations. The stock went to zero. The hundreds of millions of dollars invested by the public evaporated. The story had been a fantasy, and the investors who paid for that fantasy were left with nothing. This is the path of the 99%. It's the path of getting swept up in euphoria, of believing this time it's different, of mistaking a good story for a good business. It is the antithesis of defensive investing. It is what happens when you substitute hope for financial analysis. The margin of safety is the simple, powerful creed that protects you from this fate. It is the quiet, disciplined voice that whispers, "The story is beautiful, but what are the assets? What are the earnings? What is my downside?" By asking these questions, you build a dam that holds back the tidal wave of popular delusion. The beauty of the margin of safety principle is that it's not an abstract philosophical concept. It has a direct, quantifiable, and powerful connection to the financial reality of an investment portfolio or a corporate balance sheet. It's a way of thinking that manifests as a tangible financial advantage, creating what we can call a liquidation value floor. This floor is the ultimate form of capital preservation and the bedrock of financial security. Let's make this crystal clear with numbers. Imagine two investors, Investor A, who follows the path of the 99%, and Investor B, a disciple of Graham and Buffett. Both are analyzing a hypothetical company, Future Tech Inc. Future Tech has a great story about a new technology, and its stock is trading at $100 per share. Investor A is captivated by the narrative. He builds a spreadsheet forecasting explosive growth, plugs in optimistic assumptions, and concludes the stock could be worth $200 in a year. He sees a 100% upside and eagerly buys the stock at $100, believing he's making a smart move. He has no margin of safety. His entire thesis rests on his optimistic forecast being correct. Investor B, on the other hand, ignores the story and performs the liquidation value analysis we outlined earlier. She conservatively values the company's assets, cash, discounted receivables, heavily discounted equipment, and subtracts all its liabilities. Her pessimistic calculation concludes that if future tech were to be shut down tomorrow, its assets could be sold off for about $70 per share. This $70 is her liquidation value floor. She looks at the market price of $100 and immediately dismisses the investment. There is no margin of safety. In fact, there is a $30 margin of danger, the premium the market is charging for the hopeful story. A few months later, a competitor releases a superior product. Future tech's growth story evaporates. Panic ensues, and the stock price crashes to $50 per share. Investor A is now sitting on a 50% loss. His portfolio has suffered a devastating blow, and the math of compounding is now working viciously against him. He needs a 100% return just to get back to where he started. Now, let's consider a different company, Old Stalwart Corp. It's a boring, established business trading at $50 per share. Investor A isn't interested. The story is dull. But Investor B does her analysis. She calculates a conservative liquidation value for Old Stalwart of $70 per share. Here, the situation is reversed. The market price of $50 is substantially below the hard asset value of $70. There is a $20 per share, or 28%, margin of safety. She buys the stock. Now let's imagine the same bad luck strikes. A recession hits, and Old Stalwart's earnings decline temporarily. The stock price falls by 30%, from $50 down to $35. Investor B is temporarily down on her investment. However, her situation is fundamentally different from Investor A's. The stock price of $35 is now trading at a 50% discount to its liquidation value of $70. The investment has become even more attractive. The hard asset value provides a strong gravitational pull, a floor that limits how far the stock is likely to fall. Value investors or even private equity firms might start looking to buy the entire company at these levels, putting a floor under the price. The margin of safety doesn't prevent the stock price from fluctuating. What it does is dramatically reduce the risk of permanent capital loss. For Investor B, a temporary price dip is an opportunity. For Investor A, whose investment was based on a story, a price crash is a catastrophe because the story is broken and there is no floor of value to stop the fall. This is how the principle directly impacts wealth management and portfolio management. A portfolio constructed of investments bought with a significant margin of safety is inherently more robust. It will experience smaller drawdowns during market panics, recover faster, and compound more reliably over the long term. This is the unglamorous but profoundly powerful secret to building wealth. It is not about finding the next 10-bagger. It is about systematically constructing a portfolio where the downside is protected by a foundation of tangible, verifiable value. The human mind is a forecasting machine. We are constantly making predictions, from the trivial, how long it will take to get to work, to the monumental, which career path will bring us fulfillment. Yet, the brutal truth is that we are terrible at it. Our predictions are consistently, demonstrably, and often comically wrong. This tendency towards flawed forecasting is amplified to a dangerous degree in the world of finance, where it combines with another powerful psychological poison, over-optimism. It is this toxic cocktail of hubris and hope that the margin of safety is designed to neutralize. To see this principle in action, we must look at one of Warren Buffett's most celebrated investments, a masterclass in exploiting market panic and weaponizing humility, his purchase of American Express in the mid-1960s. The story begins with a scandal that had nothing to do with American Express's core business. A company called Allied Crude Vegetable Oil had taken out massive loans from various Wall Street banks, secured by its inventory of salad oil. The problem was, the salad oil didn't exist. The company's president, Tino DeAngelis, had perpetrated a massive fraud, filling his storage tanks mostly with water, with only a thin layer of oil on top. When the fraud was discovered, Allied Crude collapsed, defaulting on loans worth the modern equivalent of over $1 billion. One of the lenders that had issued warehouse receipts for the non-existent oil was a subsidiary of American Express. The market panicked. The question on every investor's lips was, is American Express liable for the losses? Wall Street assumed the worst. The headlines were terrifying. Lawsuits were flying. The narrative was that the scandal would bankrupt the company. Fear, amplified by dramatic and readily available news, gripped the market. The stock of American Express, a blue-chip institution, collapsed. It fell by nearly 50%, wiping out years of gains in a matter of weeks. This is where the story pivots from a tale of panic to a lesson in rational risk management. While the rest of the world was selling, Warren Buffett, then a young, relatively unknown manager of a small investment partnership in Omaha, got interested. He didn't start with a spreadsheet. He started with a question that inverted the market's panic. Is the fear justified? He understood that the market was reacting to the most vivid and recent information, the scandal. This is a classic example of the availability heuristic, a mental shortcut where our brains judge the likelihood of an event by how easily we can recall examples of it. Because the salad oil scandal was front-page news, it felt like an existential threat. Buffett's genius was to actively fight this bias by seeking out less available but far more important information. He became a detective. He engaged in what his mentor Philip Fisher called scuttlebutt. He went to banks. He went to travel agencies. He went to restaurants and hotels. He would stand in line and observe customers. He'd ask cashiers if they were seeing any slowdown in the use of American Express travelers' checks or credit cards. He'd ask merchants if they were still happy to accept American Express payments. Everywhere he went, the answer was the same. The scandal was a Wall Street story. On Main Street, the American Express brand was as powerful as ever. People still trusted their travelers' checks implicitly. The little green card was still a symbol of financial prestige and security. Buffett realized that the company's primary asset, the powerful brand loyalty in the minds of millions of customers, was completely untouched by the scandal in New Jersey. This was the company's true economic moat. Having confirmed the health of the core business, he then did the financial analysis. He calculated the absolute worst-case scenario for the salad oil losses. He made a conservative estimate of the company's sustainable long-term earning power from its card and traveler's check businesses. What he found was a massive disconnect. The market, in its terror, had priced the company as if its entire franchise was permanently impaired. The price reflected the fear. Buffett's analysis showed that even if they had to pay out the maximum possible losses from the scandal, the company's underlying earning power made it worth far, far more than its current stock price. The gap between the panic-induced price and the reality-based value was enormous. This was his margin of safety. Convinced by his research, he made one of the boldest moves of his early career. He invested 40% of his entire partnership's capital into American Express stock. It was a massive, concentrated bet, but one built not on optimism or speculation, but on a deep, quantifiable margin of safety. The outcome was spectacular. As the market's fear subsided and it became clear that the salad oil losses were manageable and the core business was a cash-generating machine, the stock price soared. Buffett's partnership made a fortune. This story is the perfect embodiment of the psychology of prudence. It teaches us that the greatest opportunities are often found not in celebrating good news, but in dispassionately investigating bad news. It demonstrates that the margin of safety is your shield against the emotional contagions of the market, allowing you to remain rational when everyone else is losing their minds. The American Express salad oil scandal is a laboratory for studying the cognitive biases that destroy wealth. The market's reaction was a textbook case of two psychological phenomena working in tandem: the aforementioned availability heuristic and its dangerous cousin, herd behavior. Understanding these on a cerebral level is crucial for anyone involved in executive decision-making or portfolio management, because they are not weaknesses of the uneducated. They are deeply ingrained in all of us. The availability heuristic, as we touched on, dictates that we assess the probability of an event based on how easily examples come to mind. The news of the salad oil fraud was sensational. It was vivid, easy to picture, and featured a clear villain. This made the threat to American Express feel immediate, massive, and highly probable. The brain, being an energy conservation machine, takes a shortcut. Instead of asking the difficult analytical question, what is the quantifiable financial impact of this subsidiary's potential liabilities on the parent company's long-term earning power? It asks a much simpler emotional question: how easily can I imagine this being a disaster? Since the media was serving up disaster scenarios on a silver platter, the answer was, quote, very easily. This led directly to the sell button. This heuristic then triggers the second and arguably more powerful bias: herd behavior. Human beings are social animals. For millennia, our survival depended on our ability to stick with the tribe. Straying from the group was a death sentence. This instinct is still deeply embedded in our cerebral cortex. In the world of finance, it manifests as a powerful urge to do what everyone else is doing. When the stock of American Express started to plummet, it created a social signal. Other investors saw the price falling and thought, others must know something I don't. I'd better sell before it goes lower. This created a self-reinforcing cascade of selling. The falling price validated the fear, which caused more selling, which created more fear. It's a feedback loop of pure emotion. No one is thinking independently. They are all just reacting to the herd's movement. The pain of being wrong alone is far greater than the pain of being wrong with the crowd. Buffett's process was a direct, systematic countermeasure to these biases. His scuttlebutt method was a conscious effort to fight the availability heuristic. He was deliberately seeking out boring data, the day-to-day transaction behavior of ordinary customers, to counteract the exciting data of the scandal. He was re-anchoring his perception of reality in the mundane, not the sensational. His independent nature and his focus on his own calculations were the antidote to herd behavior. He had done the work, he had built his conviction based on facts, and therefore he didn't need the market's validation. In fact, he saw the herd's panic not as a threat, but as a giant for sale sign, offering him a wonderful business at a ridiculous price. The margin of safety is the mechanism that allows you to do this. It is what gives you the courage to stand apart from the stampeding herd. When you know you are buying $1's worth of earning power for 50 cents, the frantic selling of others becomes a source of opportunity, not a cause for alarm. You are able to act rationally precisely because you have created a buffer that protects you from a negative outcome. You can withstand the psychological pressure to conform because you have a quantifiable analytical reason to believe the herd is wrong. Without that margin, you have nothing to hold on to but hope, and hope is no match for the primal fear of being left behind. This is why developing a sound investment strategy is not just about finance. It's about mastering your own psychology. The lesson from the salad oil scandal can be systematized into a powerful mental model for any investor or entrepreneur looking to make high-stakes decisions under pressure. We can call this blueprint the scuttlebutt inversion method. It's a process for turning market fear into your greatest asset. It begins by inverting the typical investment question. Instead of asking, what's the next hot stock that could go up a lot, you ask, what high-quality company is the market irrationally terrified of right now, and is that terror truly justified? Step 1. Identify a fallen angel. Your hunting ground is not the list of stocks hitting 52-week highs, but the list of those getting hammered. Look for an established, historically successful company with a strong brand or competitive position that has recently been hit by a wave of bad news. The stock should be down significantly, say 30 to 50% or more from its peak. This is your pool of potential opportunities. Step 2. Articulate the bear thesis. Before you do any other research, you must be able to clearly and concisely state the market's pessimistic narrative. Why is everyone selling? What is the specific fear? Is it a new competitor? A regulatory threat? A product failure? A scandal? Write it down. For American Express, the bear thesis was, The salad oil scandal will result in catastrophic liabilities that will bankrupt the company or permanently impair its brand. You must understand your enemy's argument before you can defeat it. Step 3. Become a detective. This is the scuttlebutt phase. Your mission is to find ground truth data that either confirms or refutes the bear thesis. This means going beyond the headlines and the financial statements. If the fear is about a new competitor, try the competitor's product. Talk to customers of both companies. Read industry trade journals, not just the financial news. If the fear is about a product recall, talk to engineers or safety experts. In Buffett's case, he talked to merchants and customers. The goal is to gather proprietary insights by doing the legwork that the panicked, headline-reading herd is unwilling to do. Step 4. Quantify the worst-case scenario. Now you bring it back to the numbers, but with a twist. Instead of forecasting the upside, you are going to stress test the downside. Assume the bear thesis is partially or even fully correct. What is the maximum quantifiable damage? For American Express, Buffett calculated the maximum possible legal liability from the scandal. He put a hard number on the fear. If the fear is a loss of market share, you might model a permanent 20% reduction in revenue. Be brutal. Be pessimistic. What is the absolute worst this situation could do to the company's long-term earning power? Step 5. Compare the damage to the discount. This is the final calculation. You take your worst-case scenario valuation of the company and compare it to the current market price. Let's say you analyze a company whose stock has fallen from $100 to $50. You determine that the absolute worst-case financial damage from its current troubles is about $10 per share of value. This means that in a terrible outcome, the business is still worth $90. The market, in its panic, is offering you this $90 asset for $50. This $40 gap is your margin of safety. You are being paid handsomely to take on a risk that the market has massively overestimated. This inversion method is a powerful tool for any leader, not just in investing. When your company faces a crisis, the market's or your team's first reaction will be fear. This model forces you to dispassionately quantify the real threat and separate it from the emotional narrative. It is a structured process for maintaining rationality when all hell is breaking loose, which is the hallmark of effective executive decision-making and a cornerstone of sound financial planning. The path of the 99% is paved with the emotional debris of reacting to the crowd. The antithesis of Buffett's calm, investigative approach during the salad oil scandal is the frenzied, herd-driven behavior we see time and again in speculative bubbles. A perfect modern example is the meme stock phenomenon of 2021, particularly the mania surrounding GameStop. This was not investing. It was a social contagion fueled by a potent cocktail of fear of missing out, FOMO, and a compelling narrative. The story was a classic David versus Goliath tale. A band of retail investors on a social media platform, Reddit, were taking on giant, villainous hedge funds that had heavily shorted the stock of GameStop, a struggling brick-and-mortar video game retailer. The narrative was powerful and emotionally resonant. Buying GameStop stock wasn't just a financial decision. It was a way to join a movement, to stick it to the establishment. Millions of people, many of whom had never invested before, were swept up in the frenzy. They were not performing scuttlebutt analysis. They were not calculating the company's earning power. They were reading Reddit forums, looking at rocket ship emojis, and watching the stock price go parabolic. This is the polar opposite of Buffett's method. His process is designed to isolate him from the emotions of the crowd. The meme stock phenomenon was designed to amplify those emotions. The primary driver for buying was not a margin of safety, but the stock price's upward momentum. People were buying because the price was going up, and they feared missing out on the seemingly easy gains. This is called, quote, performance chasing, and it is one of the most reliable ways to destroy capital. The herd was in full stampede. The price of GameStop disconnected from any conceivable business reality. At its peak, the company was valued at over $24 billion. This was for a business with declining revenues, a questionable business model in the age of digital downloads, and no clear path to sustainable profitability. A rational analysis would have pegged its intrinsic value at a small fraction of that price. There was no margin of safety. Investors were paying $20, maybe $50 for something that was worth $5. They were paying for the story, the excitement, and the sense of community. The inevitable crash was brutal. The narrative could not levitate the stock forever. When the buying frenzy exhausted itself, the price collapsed. It plummeted over 90% from its peak in a matter of weeks. The hedge funds were hurt, but the real victims were the legions of individual investors who had piled in at the top, driven by FOMO. They had followed the herd right off a cliff. Their stories were heartbreaking. Life savings wiped out, college funds evaporated, dreams shattered. They had learned the hard way that the stock market is not a video game. The contrast with Buffett's American Express investment is stark. Buffett bought a great business when it was temporarily hated. The meme stock investors bought a struggling business when it was temporarily loved. Buffett bought based on a massive discount to conservatively calculated intrinsic value. They bought based on a massive premium to a fantasy valuation. Buffett's success was determined by the company's long-term business performance. Their success was dependent on finding a greater fool to sell to at an even higher price. This is the critical lesson. The margin of safety forces you to be a business analyst. The path of the 99% seduces you into being a market speculator. One path leads to the steady, quiet compounding of wealth. The other leads to a thrilling ride, followed by a catastrophic crash. The direct financial connection of the margin of safety, as illustrated by the American Express case, moves beyond the simple concept of hard assets. It introduces a more sophisticated and powerful idea: the gap between a company's market price and its true, sustainable, earning power value. This is a concept that is central to modern value investing, wealth management, and private equity analysis. Let's quantify this. Imagine a wonderful business, like American Express at the time, that consistently earns $5 per share, year after year. In a normal, calm market, a stable and growing company like this might be valued by investors at a price-to-earnings (PE) ratio of 15. This is a common multiple for a quality business, so its normal market price would be $5, earnings times 15 multiple, which equals $75 per share. This $75 represents a fair estimate of its intrinsic value based on its demonstrated ability to generate cash for its owners. Now, a crisis hits, a scandal, a recession, a temporary business problem. The herd panics. The narrative turns negative. Investors, driven by the availability heuristic and herd behavior, sell indiscriminately. The PE multiple that the market is willing to pay for those same earnings collapses from 15 down to 7. The earnings are still $5 per share. Buffett's scuttlebutt research confirmed the core business was fine, but the stock price has fallen to $5 times 7, which is $35 per share. This is the moment of opportunity. The intrinsic value, based on long-term earning power, is still around $75. But the market price is only $35. The gap between the two, the $40 difference, is your margin of safety. This is a fortress of protection. What does this $40 buffer do for you? First, it protects you if you are wrong. What if your analysis was too optimistic and the company's sustainable earnings are not $5 but only $4? At a normal multiple of 15, the business is actually worth $60. If you had paid the old price of $75, you would have overpaid and would likely lose money. But because you bought at $35, you are still buying a $60 business for $35. You make a handsome profit despite your analytical error. This is crucial. The margin of safety makes a precise forecast of the future unnecessary. Second, it provides massive upside potential. As the fear subsides and the market returns to its senses, the PE multiple will likely expand from the crisis level of 7 back towards its historic average of 15. When this happens, the stock price will rise from $35 back to $75, giving you more than a 100% return. The margin of safety not only protects your downside but also creates the conditions for outsized gains on the upside. This concept is the engine of all sophisticated portfolio management. Professional investors and private equity firms are constantly searching for these disconnects between price and earning power value. They understand that you don't get rich by buying average companies at fair prices. You get rich by buying great companies when they are on the operating table, when a temporary problem has created a moment of irrational pessimism. The margin of safety is the financial tool that allows you to identify these opportunities, and the psychological tool that gives you the conviction to act on them. It transforms market volatility from a source of risk into the primary source of your long-term returns, laying a secure foundation for building wealth. Warren Buffett's evolution as an investor is a journey from buying good assets to buying good businesses. The pivotal moment in this journey, the one that truly solidified his partnership with Charlie Munger and set the stage for Berkshire Hathaway's modern success, was the acquisition of a seemingly simple business in 1972, See's Candies. This story is crucial because it expands the concept of the margin of safety beyond the balance sheet and into the more abstract, yet far more powerful realm of intangible assets and economic moats. See's was a beloved, family-owned chocolate company based in California. It was being sold by the See family, and they were asking for $30 million. Buffett and Munger took a look. Their initial Graham-style analysis was not encouraging. The company had tangible assets, factories, stores, inventory, worth only about $8 million. The asking price was nearly 4 times the book value. For a strict disciple of Ben Graham, this would have been an immediate no. The margin of safety, based on assets, simply wasn't there. But Charlie Munger pushed Buffett to look deeper. He urged him to consider not just what the business owned, but what the business was. They began to analyze the company not as a collection of assets, but as an economic franchise. What they discovered was a business of extraordinary quality. See's had a fanatically loyal customer base. People who grew up with See's chocolates associated them with holidays, birthdays, and celebrations. It was a cherished family tradition. This intense brand loyalty gave See's something magical: pricing power. Every year, the CEO, Chuck Huggins, could raise prices by a modest amount to cover inflation and then some, and the customers would barely notice. They weren't just buying chocolate. They were buying nostalgia, quality, and a piece of their family's history. They would happily pay a few cents more for it. This ability to raise prices without a significant loss in business is the hallmark of a truly great business. It meant that the company was a cash-generating machine that could grow its earnings without needing to invest huge amounts of new capital. The brand itself, an intangible asset that didn't show up on the balance sheet for its full worth, was the source of a massive competitive advantage, or moat. Buffett and Munger realized that the true margin of safety in See's Candies wasn't in its liquidation value. It was in the gap between the purchase price of $25 million, they negotiated it down, and the present value of all the cash the business could be expected to generate for decades to come, thanks to its durable brand and pricing power. They were buying a wonderful company at a fair price rather than a fair company at a wonderful price. This was a profound intellectual leap. It required them to do something that makes most people deeply uncomfortable: forecast the future. But they did it with an immense degree of conservatism. They weren't projecting wild speculative growth. They were underwriting the simple, predictable continuation of a business they understood inside and out. The purchase of See's for $25 million has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that required almost no additional capital investment. It became the prototype for the kind of businesses Buffett would seek out for the rest of his career: companies with deep, defensible moats that provided a margin of safety based on future earnings, not just current assets. This story is a testament to an even deeper psychological principle: the need to overcome our own limitations. The reason we demand a margin of safety is because we must acknowledge our own fallibility as forecasters. The See's Candies story reveals the psychological hurdle that every serious investor must clear: our own deep-seated overconfidence in our ability to predict the future. This cognitive flaw is so universal that it has a name: the planning fallacy. Coined by psychologists Daniel Kahneman and Amos Tversky, the planning fallacy describes our systematic tendency to underestimate the time, costs, and risks associated with future actions, while simultaneously overestimating the benefits. It's why major infrastructure projects always run over budget and behind schedule. It's why you think you can finish a week's worth of work in 2 days. And in finance, it's why investors consistently believe their forecasts are more accurate than they really are. Coupled with this is the overconfidence bias, our tendency to have excessive faith in our own judgments and abilities. Studies have shown that most people rate themselves as above-average drivers, have an inflated sense of their own intelligence, and believe they are less biased than the average person. In investing, this manifests as a belief that we can pick winning stocks, time the market, and predict economic turns with a skill that we simply do not possess. Warren Buffett's entire philosophy is an operating system designed to counteract these two powerful biases. When he and Munger analyzed See's Candies, they were not immune to the planning fallacy. They had to project future cash flows, which is an act of prediction. But the way they did it was fundamentally different from how the 99% operate. They limited their forecasts to businesses that were simple and understandable. Chocolate is not a complex technology. The reasons for its success, brand loyalty, quality product, were durable and unlikely to be disrupted overnight. They weren't trying to predict the future of a biotechnology company or a complex software firm. They stayed within what Buffett calls his circle of competence. Furthermore, they were not looking for precision. Buffett famously says, "It's better to be approximately right than precisely wrong." Their projection of See's future was likely a simple, conservative estimate of modest growth. They didn't need a 100-page spreadsheet. They needed to understand the core, enduring economics of the business. The margin of safety, in this context, is the bridge between the uncertainty of the future and the need to make a decision today. By demanding a fair price for a wonderful business, not an exorbitant one, they were building in a buffer for error. They were saying, "We believe this business will generate a great deal of cash for a very long time. But we are humble enough to know that our forecast could be wrong. The world could change in ways we can't foresee. A new competitor might emerge, consumer tastes might shift. Therefore, we will only buy it at a price that gives us a substantial margin for error. If the future is only half as good as we expect, we will still get a satisfactory result." This is a profound act of weaponized humility. The vast majority of investors do the opposite. They venture far outside their circle of competence, buying into complex stories they don't truly understand. They build incredibly detailed and precise financial models that give them a false sense of security. And they pay prices that leave no room for error, prices that implicitly assume their optimistic forecasts are 100% accurate. When reality inevitably falls short of their rosy predictions, the lack of a margin of safety means their capital is decimated. The secret to the Buffett-Munger approach is this: they don't try to eliminate uncertainty, they embrace it. They accept their limitations as forecasters. And they use the margin of safety as the practical tool that allows them to invest successfully in spite of that uncertainty. Translating the wisdom of the See's Candies purchase into a practical blueprint requires a tool for estimating the value of a business based on its future earning power. The most common method is the discounted cash flow, or DCF analysis. Now, Wall Street has turned the DCF into a monstrously complex art form, but its core logic is actually quite simple and can be used by anyone. Here is a blueprint for a DCF for the layman, a simplified process that captures the spirit of Buffett's approach. Step 1. Find the owner earnings. Don't get bogged down by reported net income, which can be distorted by accounting rules. Buffett prefers a concept he calls owner earnings. A simple proxy for this is net income plus depreciation and amortization, which are non-cash charges, minus the average annual amount of capital expenditures needed to maintain the business's current position. This last part is key. You only subtract the maintenance CapEx, not growth spending. In essence, you're asking, how much cash could the owner take out of this business each year without harming its long-term competitiveness? This is the true cash flow of the business. Step 2. Project the owner earnings. This is the most subjective part, and where conservatism is paramount. Project the owner earnings you calculated in Step 1 out for the next 10 years. The critical input here is the growth rate. Do not use a hockey stick projection. Look at the company's past growth, the industry's growth, and be realistic. For a stable, mature business like C's, you might use a conservative growth rate of 3 to 5% per year. For a slightly faster-growing business, maybe 7%. Be very skeptical of any projection that assumes double-digit growth for a decade. The planning fallacy will tempt you to be optimistic here. You must resist. Step 3. Apply a terminal value. A business doesn't stop existing after 10 years. You need to estimate its value from year 11 into perpetuity. A simple way to do this is to take the owner earnings from year 10 and assume they will grow at a very slow, stable rate forever, like the long-term rate of inflation, say 2.5%. You then use a formula called the perpetuity growth model to calculate the value of that long-term stream of cash. Don't worry about the math. Online calculators can do it for you. The key is using a very low perpetual growth rate. Step 4. Discount everything back to today. $1 in 10 years is worth less than $1 today. You need to discount all of those future cash flows, from years 1 through 10 plus the terminal value, back to their present value. The rate you use for this is the discount rate. A common and conservative choice is the yield on the 10-year U.S. Treasury bond plus an equity risk premium of a few percentage points. Let's say the total discount rate is 7%. This rate reflects the time value of money and the risk of investing in stocks over safe government bonds. Step 5. Sum it all up. The sum of all those discounted future cash flows is your estimate of the company's intrinsic value. This number represents what the business is worth to a rational private owner. The final and most important step: demand the margin of safety. The intrinsic value you just calculated is not your buy price. It is your estimate of worth. Your buy price must be significantly lower. You must demand a discount to that calculated value. For a very stable, predictable business, you might require a 25% margin of safety. For a business with more uncertainty, you should demand 40% or even 50%. So if your conservative DCF analysis tells you a business is worth $100 per share, you should only be willing to buy it at a price of $75, $60, or even $50. That discount is your protection against the unknowable future and the inevitable errors in your own forecasting. This process, even in this simplified form, forces a disciplined, long-term business owner mindset, which is the absolute core of any successful investment strategy or high-level financial planning. The antithesis of Buffett's approximately right approach to valuation is the culture of the spreadsheet guru that permeates Wall Street and corporate finance. This is the path of false precision, the belief that a more complex model is a more accurate one. It's an intellectual trap that creates an illusion of control while completely ignoring the fundamental nature of an unknowable future. Imagine a young, brilliant analyst at a major investment bank. Their job is to value a company. They will build a financial model in Excel that is a work of art. It will have dozens of tabs, thousands of rows, and hundreds of input variables. They will project revenue not just for 10 years, but for 30. They won't just forecast sales for the whole company. They'll do it by product line, by geographic region. They will model changes in market share down to 2 decimal places. They will have complex algorithms for depreciation schedules and tax rates. At the end of this Herculean effort, the model will spit out an answer. The intrinsic value of the company's stock is $101.57. The stock is currently trading at $98. The analyst's conclusion: buy. We have a 3.6% upside. This is the height of absurdity, yet it happens every single day. The problem is that this incredible precision is built on a foundation of pure guesswork. Each of those hundreds of input variables is just a forecast, a shot in the dark. The analyst has no real idea what market share will be in year 7, or what tax rates will be in year 15. But by encasing these guesses in a complex mathematical edifice, they create a powerful illusion of accuracy and intellectual rigor. This is dangerous for two reasons. First, it leads to a complete lack of a meaningful margin of safety. The analyst who thinks a stock is worth $101.57 is perfectly happy to buy it at $98 or even $100. Their model has told them the precise value, so any price below that seems like a good deal. They are taking on enormous risk for a trivial potential reward, all because they trust their own impossibly detailed forecast. They are building a bridge designed to hold exactly the expected load, with no room for error, surprises, or bad luck. Second, it creates a focus on the minutiae at the expense of the big picture. The analyst spends weeks debating whether the growth rate in year 5 should be 4.5% or 4.7%, while completely missing the larger, more important question: does this business have a durable competitive advantage? Is this an industry that is likely to exist in 20 years? These are the big picture questions that Buffett and Munger obsess over. They know that if you get the qualitative aspects right, the quality of the business, the moat, the management, the precise numbers will largely take care of themselves. The spreadsheet guru is a perfect example of the overconfidence bias and the planning fallacy run amok. Their complex models are a monument to the human desire to control and predict the future. Buffett's approach is a testament to the wisdom of accepting that you can't. By using simple models, conservative assumptions, and focusing only on businesses he can understand, he acknowledges his own limitations. And by then demanding a huge margin of safety on top of that, he ensures that he wins not because his forecast is right, but because he has structured the investment so that he doesn't need it to be. He is playing a different game, one based on humility and prudence, not on the hubris of a complex spreadsheet. The direct financial connection between demanding a discount on future earnings and long-term success can be illustrated by looking at the mathematics of a discounted cash flow model. The margin of safety is not just a qualitative concept, it's a quantifiable variable that dramatically alters the risk profile of an investment. Let's walk through a simple, powerful example. Imagine you are analyzing a business, and your best, most realistic projection is that 10 years from now, it will be generating owner earnings of $1 billion. To figure out what that future billion-dollar stream is worth today, you need to discount it back to the present. Let's use a discount rate of 7%, a reasonable figure. The math tells us that $1 billion received in 10 years, discounted at 7%, has a present value of roughly $508 million. Now let's say you are a typical, overconfident investor. You trust your forecast. You believe the company will earn $1 billion. So you are willing to pay up to $508 million to buy the company today. You buy it for a price of $500 million, leaving yourself a tiny sliver of a margin of safety. But the future is rarely what we expect. A new competitor emerges, the economy slows down, a key product fails. 10 years later, the company is only generating $700 million in owner earnings, 30% less than you predicted. Your forecast was significantly wrong. What is the present value of that $700 million? Discounted at 7%, it's only about $356 million. You paid $500 million for an asset that turned out to be worth only $356 million. You have suffered a permanent capital loss of nearly 30%, a disaster for your portfolio. Now let's rewind and imagine you are a disciplined, Buffett-style investor. You make the exact same forecast. You expect $1 billion in earnings in 10 years with a present value of $508 million. But you are humble. You know your forecast is probably wrong, so you demand a 50% margin of safety. You are only willing to buy this business if the market offers it to you for half of your estimated intrinsic value. Your maximum buy price is $254 million. You wait patiently, and one day, during a market panic, the price drops to that level and you buy it. Now fast forward 10 years, the same disappointing future unfolds. The company only earns $700 million. The intrinsic value of the business, as we calculated, is $356 million. But what was your result? You paid $254 million for an asset that turned out to be worth $356 million. Despite your forecast being wildly optimistic and 30% wrong, you still made a profit of over 40%. You succeeded not because you could predict the future, but because you built a financial structure that was resilient to the surprises the future would inevitably bring. This is the entire game. The margin of safety is a financial shock absorber. It is the explicit recognition of uncertainty, built directly into your valuation. It separates a professional approach to risk management from amateur speculation. It is how you ensure that even when you are wrong, and you will be wrong, you still don't lose money, which is the first and most important rule for building wealth and achieving lasting financial security. There is no greater test of an investment philosophy than a full-blown financial crisis. In the fall of 2008, the global financial system was on the verge of collapse. Lehman Brothers had filed for bankruptcy, AIG was bailed out, and credit markets were frozen solid. The world was gripped by a level of fear not seen since the Great Depression. For most investors, it was a time of catastrophic loss and paralyzing panic. For Warren Buffett and Berkshire Hathaway, it was the Super Bowl. His performance during this period is the ultimate foundational anecdote for why capital preservation is the most powerful offensive weapon an investor can possess. While the rest of the world was frantically selling, Buffett was the calm at the center of the storm. He wasn't panicking because his entire life's work had been a preparation for this very moment. For years during the housing bubble, he had been criticized for sitting on a massive pile of cash, earning pitiful returns while the market soared. Commentators said the old man had lost his touch. But Buffett wasn't focused on maximizing short-term returns. He was focused on maintaining a fortress-like balance sheet. His portfolio of businesses was bought with a margin of safety. He had rigorously avoided the complex, leveraged derivatives that were blowing up Wall Street. He had almost no debt. As a result, when the storm hit, Berkshire Hathaway wasn't a ship taking on water. It was the only lighthouse for miles. And then, the phone started ringing. The calls came from the CEOs of the most powerful companies in America, companies that were, just weeks earlier, the titans of the universe. Now they were desperate. One of the first calls was from Goldman Sachs, the premier investment bank on Wall Street. They needed capital, and they needed the ultimate stamp of approval to calm the markets. They needed Warren Buffett. The terms Buffett was able to extract were nothing short of breathtaking. He invested $5 billion in Goldman Sachs preferred stock that paid him a 10% annual dividend, $500 million a year guaranteed. On top of that, he received warrants that gave him the right to buy $5 billion worth of common stock at a fixed price for the next 5 years. It was an incredibly lucrative deal, one that would only be offered to someone who had the capital and the reputation to be the lender of last resort. A few weeks later, another icon of American industry, General Electric, came calling. They too were facing a crisis of confidence. Buffett struck a similar deal, investing $3 billion in GE preferred stock, also paying a 10% dividend and also receiving warrants. In the depths of the crisis, when everyone else was forced to sell their best assets at fire sale prices, Buffett was deploying his capital like an invading army, buying pieces of America's best businesses on terms that would generate massive returns for decades. This was only possible because of his lifelong adherence to the margin of safety. That principle had guided him to avoid the speculative excesses of the bubble, ensuring his capital was preserved. That principle had led him to build a corporate structure that was unlevered and awash in cash. His defense, his obsessive focus on not losing money, had created the single greatest offensive opportunity of his lifetime. He was able to act with courage and conviction because he wasn't playing the same game as everyone else. He wasn't trying to squeeze out the last percentage point of return in the good times. He was preparing his fortress for the inevitable siege. When the siege came, he was not the one defending the walls. He was the one selling supplies to the desperate at a king's ransom. This is the ultimate lesson in portfolio management. True long-term outperformance doesn't come from capturing all of the upside in a bull market. It comes from preserving your capital during the downturns so that you are one of the few left standing with the resources and the nerve to buy when there is blood in the streets. The behavior of investors during the 2008 crisis and Buffett's masterful counterplay can be explained by one of the most powerful and well-documented principles in behavioral science: loss aversion. This is the simple but profound discovery that for human beings, the psychological pain of losing something is about twice as powerful as the pleasure of gaining the equivalent amount. Losing a $100 bill feels far worse than the joy you get from finding one. This asymmetrical response to gains and losses is a core driver of irrational financial behavior and is the reason why Buffett's rule number 1, never lose money, is not just a folksy saying, but a deeply insightful psychological directive. Loss aversion explains why so many investors self-destruct during market downturns. As the market falls and their portfolio value shrinks, the intense pain of those losses triggers the brain's primal fear circuits. The rational, analytical part of the brain, the prefrontal cortex, is hijacked by the emotional, fight-or-flight center, the amygdala. This leads to disastrous decisions. The overwhelming desire to make the pain stop causes them to sell everything at the point of maximum pessimism, locking in their losses and ensuring they miss the eventual recovery. It also creates a phenomenon known as get-back-itis. An investor buys a stock at $50 and it falls to $30. The pain of that 40% loss is so great that their decision-making becomes anchored to their original purchase price. They refuse to sell, not because they've reanalyzed the business and believe it's a good investment at $30, but because they are desperately hoping to get back to even at $50. This often leads them to hold on to deteriorating assets for far too long, turning a manageable loss into a catastrophic one. Buffett's entire investment philosophy is an architectural system designed to bypass the destructive effects of loss aversion. The margin of safety is the first line of defense. By buying assets for significantly less than they are worth, you are preemptively reducing the probability of experiencing a large permanent loss of capital. Stock prices will fluctuate, but if you have a bedrock of value underneath your purchase price, the risk of a true, irreversible loss is minimized. This is psychologically critical. A portfolio built on these principles will be more stable and experience smaller drawdowns. This stability prevents the investor's amygdala from being triggered. Because you avoid the deep, gut-wrenching 50% or 60% losses, you are far less likely to succumb to a panic-induced selling frenzy. You are able to remain rational and long-term oriented because the system itself is designed to avoid the very stimulus that causes irrationality. This is why his second rule, don't forget rule number 1, is so important. He is reminding himself and his shareholders that the entire edifice of Berkshire Hathaway is built on a foundation of avoiding the kind of big mistake that triggers the destructive cycle of loss aversion. His actions in 2008 were the result of this discipline. He was not experiencing the pain of loss, so his rational brain was fully in command. While others were consumed by fear, he was able to calmly analyze the opportunities presented by their panic. He had engineered his financial and psychological state to be the exact opposite of the markets. By making capital preservation the primary goal, he ironically created the conditions for the greatest capital appreciation. He understood that in finance, the best offense is a truly impenetrable defense. The way Buffett structured Berkshire Hathaway and his own finances to thrive in 2008 can be abstracted into a powerful mental model that anyone, from an individual managing their personal finances to an entrepreneur building a business, can use. This blueprint is called the Permanent Capital Vehicle Strategy. Its goal is to create a financial structure that is not just resilient, but anti-fragile, a structure that actually gets stronger from crises. Step 1. Focus on generating float. The engine of Berkshire Hathaway for many years was its insurance businesses. Insurance companies collect premiums up front and pay out claims later. This pool of capital that they hold in the meantime is called float. Buffett realized that this float was a permanent source of capital that he could invest for Berkshire's benefit. For an individual or a non-insurance business, the equivalent is to prioritize the generation of consistent, predictable, and recurring cash flow. This could be from a stable salary, rental properties, a subscription-based business, or a portfolio of dividend-paying stocks. This reliable cash inflow is your personal float. It is the foundation of your fortress. Step 2. Systematically avoid leverage. The single greatest enemy of the margin of safety and long-term financial security is debt. Leverage acts as an amplifier. It amplifies gains in the good times, but it lethally amplifies losses in the bad times. A 20% decline in the value of a fully owned asset is a manageable setback. A 20% decline in the value of a highly leveraged asset can be a complete wipeout, triggering margin calls and forced selling at the worst possible moment. The permanent capital vehicle strategy demands that you live below your means and that your business operates with a conservative balance sheet. The goal is to never be in a position where you can be forced to sell anything by a creditor. Step 3. Treat cash as a strategic asset. The conventional wisdom in financial planning is that cash is trash because it loses value to inflation. This is true in normal times, but in a crisis, cash is not trash, cash is king. It is oxygen. The permanent capital vehicle strategy requires you to maintain a large cash position, not as a drag on returns, but as what Charlie Munger calls call options on future opportunity. You should view your cash reserve as a war chest, waiting patiently for the day when others, who were fully invested and leveraged, are forced to sell their pristine assets to you at bargain prices. Step 4. Be the lender of last resort. This is the culmination of the strategy. You have spent years building your cash flow, avoiding debt, and accumulating a cash pile. Then, a crisis hits. The market is in turmoil. Credit is tight. Panic is everywhere. This is your moment. Because you have capital when no one else does, you are in a position of immense power. You can now deploy your cash to buy wonderful assets, whether they are stocks, real estate, or entire businesses, from desperate sellers at prices that offer an enormous margin of safety. This is how you turn a market crisis from a terrifying threat into a generational wealth-building opportunity. This four-step process is a direct replication of Buffett's strategy. It is a long-term plan for financial success that is built on prudence, patience, and the courage to be greedy when others are fearful. It's a core concept in sophisticated wealth management and private equity, and it's the surest path to achieving unshakable financial security. The antithesis of Buffett's fortress-building strategy is a deeply embedded philosophy in modern finance, the cult of constant optimism and full investment. It's the pervasive belief that you must be 100% invested at all times, that holding cash is a cardinal sin, and that employing leverage is a sophisticated tool for juicing returns. This approach works wonderfully during a long, uninterrupted bull market, but it carries the seeds of its own destruction, leading to absolute catastrophe when the tide inevitably goes out. The poster child for this flawed ideology was a hedge fund named Long-Term Capital Management, or LTCM. The story of LTCM is a cautionary tale of hubris and the failure of theoretical brilliance in the face of real-world risk. The firm was founded in 1994 by a dream team of financial superstars. It included John Meriwether, the legendary bond trader from Salomon Brothers, and, most notably, two Nobel Prize-winning economists, Myron Scholes and Robert Merton, whose work on options pricing was the foundation of modern financial theory. Their strategy was to use complex computer models to find tiny, temporary pricing discrepancies in global bond markets. They would then use enormous amounts of leverage, borrowed money, to turn these tiny discrepancies into significant profits. For every $1 of their own capital, they were borrowing and investing more than $25. Their models, designed by the Nobel laureates, told them that the risks were infinitesimally small. They believed they had created a perfect money-printing machine. For 4 years, it worked like a charm. They generated spectacular returns, and their partners became fabulously wealthy. They were the toast of Wall Street, hailed as geniuses who had finally tamed risk. They had absolutely no margin of safety in their strategy. Their system was predicated on the future behaving according to the statistical probabilities of the past. It was a system built for a world of orderly, predictable risk, not for chaos. In 1998, chaos arrived. Russia defaulted on its government debt. This was a black swan event that their models had not predicted. The shockwave from this default triggered a global flight to safety. Investors around the world dumped risky assets and piled into the safest U.S. Treasury bonds. The tiny pricing discrepancies that LTCM was exploiting did not converge as their models predicted. They diverged violently. Because of their massive leverage, their small losses were amplified into catastrophic ones. Every day they were losing hundreds of millions of dollars. The geniuses were paralyzed. Their models were useless. They were facing a complete wipeout, and because of their size and interconnectedness, they threatened to bring the entire global financial system down with them. The Federal Reserve was forced to intervene and orchestrate a massive bailout by a consortium of Wall Street banks to prevent a systemic collapse. LTCM is the ultimate example of the path of the 99%. It represents the pinnacle of intellectual arrogance, the belief that risk can be perfectly measured and managed by a complex formula. It is the direct opposite of Buffett's humility. Buffett's margin of safety is a simple, robust rule of thumb, designed to protect against the things that cannot be modeled: human panic, unpredictable shocks, and the radical uncertainty of the future. The Nobel laureates at LTCM thought they were smarter than the market. Buffett operates on the profound assumption that the market and the world itself will always be capable of surprising him. That assumption is the source of his resilience and his enduring success. The direct financial connection between capital preservation and long-term wealth creation lies in the brutal, unforgiving mathematics of compounding and drawdowns. This is not a matter of opinion. It is a law of finance. Avoiding large losses is far more powerful than achieving spectacular gains. This is the financial core of building wealth, and the reason why Buffett's rule number 1 is the most profitable advice he has ever given. Let's use simple numbers to make this undeniably clear. Imagine two investors, Investor A and Investor B, who both start with $100,000. Investor A is aggressive. He chases high-flying stocks and uses leverage. In year 1, a bull market, he has a phenomenal year and makes a 50% return. His portfolio grows to $150,000. In year 2, a bear market hits, and his risky portfolio crashes by 50%. A 50% loss on $150,000 is $75,000. His portfolio is now worth only $75,000. Over 2 years, despite having a year of spectacular gains, he has lost 25% of his original capital. Now consider Investor B. She is a defensive investor who prioritizes capital preservation. In the bull market of year 1, she is more cautious. She buys solid companies at reasonable prices. She only makes a 20% return. Her portfolio grows to $120,000. She underperforms the aggressive Investor A significantly. In the bear market of year 2, her portfolio of safer margin of safety investments also declines, but it only falls by 10%. A 10% loss on $120,000 is $12,000. Her portfolio is now worth $108,000. Over the same 2 years, Investor B, the boring defensive investor, has made a profit of 8%, while the aggressive investor has suffered a massive loss. The reason for this divergence is what investors call the arithmetic of drawdowns. When you lose 50% of your capital, you don't need a 50% gain to get back to even. You need a 100% gain on your remaining capital just to break even. A large loss creates a deep hole that is incredibly difficult to climb out of. The smaller loss of 10% experienced by investor B, however, only required a subsequent gain of about 11% to get back to her starting point. This is a much more achievable feat. Over a lifetime of investing, this effect is magnified enormously. The power of compound interest, which Albert Einstein supposedly called the eighth wonder of the world, can only work its magic if it has a stable capital base to grow upon. Large drawdowns are like hitting the reset button on compounding. A portfolio that grinds out a steady 10% a year with minimal drawdowns will, over decades, end up vastly larger than a volatile portfolio that averages 12% but suffers periodic 40 to 50% crashes. This is the financial manifestation of the tortoise and the hare. The margin of safety is the tortoise's shell. It is the structural element that protects your capital from the devastating setbacks that permanently cripple the high-flying, aggressive hares. It ensures that the inexorable, patient power of compounding works for you, not against you. This is the simple, unglamorous, and mathematically certain secret to achieving long-term financial security and building lasting wealth. The world is not a predictable linear system. It is a chaotic, complex arena where the most significant events are by their very nature impossible to foresee. No one in 1913 could have predicted the outbreak of World War I. No one in 1995 could have fully grasped the societal transformation the internet would unleash. And no one in 2019 had a global pandemic in their 5-year financial forecast. These are black swans. In the parlance of author Nassim Nicholas Taleb, high-impact, low-probability events that render all our careful predictions obsolete. An investment philosophy that does not account for the existence of black swans is not just flawed, it is doomed to fail. The margin of safety is the single most powerful tool for building a portfolio that is robust to these unseen catastrophes. A perfect illustration of this is Warren Buffett's investment in the Washington Post Company in 1973. On the surface, it looked like a terrible time to be buying a newspaper stock. The country was in the midst of a brutal bear market, the economy was struggling with stagflation, and the Washington Post itself was embroiled in the Watergate scandal, facing immense political pressure from the Nixon administration. On top of all this, the entire newspaper industry was facing a long-term existential threat from the rise of television news. The list of things that could go wrong was long and terrifying. The market, understandably, hated the stock. The company's stock price had been crushed, falling by more than half. The prevailing narrative was one of doom and gloom. But Buffett once again ignored the narrative and the litany of known risks. He did his analysis. He saw a business with an unassailable competitive moat. The Washington Post was the dominant newspaper in a powerful and affluent city. It was the essential morning read for every politician, lobbyist, and business leader in the nation's capital. This gave it tremendous pricing power with advertisers. It had a local media monopoly. He also saw brilliant and high-integrity management in Katharine Graham. He looked at what the entire business, the newspaper, its television stations, its Newsweek magazine's subsidiary, would be worth to a rational private buyer. He calculated this private market value to be at least $400 million and possibly as much as $500 million. The stock market, in its fear and obsession with the short-term threats, was valuing the entire company at just $80 million. Buffett saw this and acted decisively. He invested over $10 million, acquiring a large stake in the company. The gap between the $80 million price tag and the $400 million value was an astronomical margin of safety. This margin was his protection against all the things he knew were risks, and more importantly, against all the things he couldn't possibly know. What if the political pressure from Watergate had somehow damaged the business? The margin of safety would protect him. What if the rise of television eroded newspaper profits faster than expected? The margin of safety would protect him. What if an unknown, unforeseen disaster struck the company? The margin of safety was so large that it could absorb an incredible amount of bad luck and error. As it turned out, the Washington Post not only survived the turmoil, but thrived. The Watergate reporting that so terrified the market ended up cementing its reputation as one of the world's greatest journalistic institutions, strengthening its brand for decades. The investment became one of the most successful of Buffett's career, turning his initial $10 million stake into a position worth over $1 billion. The key lesson is that Buffett did not succeed because he correctly predicted the outcome of Watergate or the future of television. He succeeded because he bought the company at a price so cheap, with a margin of safety so wide, that he did not need to be a prophet to win. He had rendered the unknowable future far less threatening. The existence of unknowable high-impact black swan events requires a robust mental framework for making decisions under uncertainty. Since we cannot predict the future, our only rational course of action is to build systems that are resilient to it. The margin of safety is the investment-specific application of this idea. A more general life and finance blueprint that stems from this same core principle is the barbell strategy, also popularized by Nassim Taleb. It is a practical and powerful way to structure your affairs to not only survive shocks but potentially even benefit from them. The strategy is simple. Imagine a barbell, with most of the weight on one side and a small amount on the other, with nothing in the middle. You apply this structure to your capital, your career, or even your time. Step 1. Load up the safe side. You allocate the vast majority of your resources, say 85 to 90%, to extremely safe, predictable, and robust assets or activities. This is the capital preservation side of the barbell. In investing, this would mean putting 90% of your portfolio into investments bought with a massive margin of safety, like Buffett's Washington Post purchase, or into the financial equivalent of a mattress, like U.S. Treasury bills. The goal here is to be hyper-conservative. You are not trying to generate high returns with this portion of your capital. You are trying to ensure its absolute survival. Your primary aim is to be protected from a catastrophic black swan event. In your career, this could mean having a stable, secure job that provides a reliable income. Step 2. Add a little high-risk exposure. With the remaining small portion of your resources, 10 to 15%, you do the exact opposite. You take small, calculated risks with massive, uncapped upside potential. This is the high-reward, moonshot side of the barbell. In investing, this could mean allocating 10% of your portfolio to a handful of carefully selected venture capital funds or speculative startup companies. The key is that your maximum loss is limited to the small amount you invested. You can only lose 10% of your total capital. However, if one of those startups becomes the next Google, your upside is virtually unlimited. It has an asymmetric payoff profile. In your career, while holding your stable job, this could mean using your weekends to start a side business, write a novel, or learn a cutting-edge skill like artificial intelligence. The failure of these ventures will not bankrupt you, but the success could be life-changing. What the barbell strategy explicitly forbids is the mushy middle. This is where most people live. They put 100% of their money into medium-risk balanced mutual funds. They take jobs with medium security and medium upside. This is the most fragile position to be in. You are exposed to downside risk from black swan events, but you have no exposure to the massive positive upside of them. Your risks are not capped, and your potential rewards are not unlimited. The barbell strategy is the margin of safety applied to your entire life. The 90% safe allocation is your ultimate protection against ruin, your guarantee that you will survive the storm. The 10% speculative allocation is your ticket to benefiting from positive black swans, the unpredictable opportunities that can create extraordinary wealth and success. It is a conscious, deliberate strategy for thriving in a world we cannot predict, a perfect blend of defensive investing and calculated risk-taking for entrepreneurs and individuals alike. The philosophy of building a fortress against the unknown stands in stark contrast to the dominant academic theory of finance that has governed Wall Street and university endowments for the last half-century, modern portfolio theory, or MPT. While mathematically elegant, the path of MPT represents the antithesis of the common-sense robustness of the margin of safety, and its failures highlight the dangers of relying on models that mistake the map for the territory. MPT, for which Harry Markowitz won a Nobel Prize, argues that risk can be measured by the historical volatility of a stock, a metric called standard deviation or beta. A stock that fluctuates a lot is considered risky. A stock that is stable is considered safe. The theory then posits that by combining various assets with different risk profiles and correlations, you can construct an efficient frontier of optimal portfolios that offer the highest possible return for a given level of risk. This sounds wonderfully scientific and reassuring. The problem is that its core premise is fundamentally flawed. MPT's definition of risk is a stock's price volatility, not the probability of a permanent loss of capital. For Warren Buffett, this is absurd. He famously said, "I would rather earn a lumpy 15% over time than a smooth 12%. He does not care if a stock price bounces around, as long as the underlying business value is secure and growing. In fact, he views volatility as a source of opportunity, as it allows him to buy great businesses from panicked sellers. The 2008 financial crisis exposed the fatal flaw of MPT. The models used by banks and investment funds were all based on historical data from relatively normal market periods. They assumed that the correlations between different asset classes, stocks, bonds, real estate, were stable. But when the black swan of the subprime mortgage collapse hit, everything changed. Correlations all went to 1. Everything crashed at the same time. The diversification that was supposed to protect these portfolios completely failed because the models could not account for a world they had never seen before. The models broke down at the precise moment they were needed most. The margin of safety, by contrast, is a much more robust and intellectually honest approach to risk management. It does not rely on complex statistical models of the past. It relies on a simple, timeless principle: buy something for much less than you think it's worth. This principle works regardless of stock market volatility or asset class correlations. Its definition of risk is intuitive and correct. Risk is not a squiggly line on a chart. Risk is paying too much for an asset and suffering a permanent loss of your money. The practitioners of MPT, much like the geniuses at LTCM, fell into the trap of believing their sophisticated models had tamed the wild randomness of the world. They built a system that was optimized for the world they knew, making it incredibly fragile to the world they couldn't predict. Buffett, the small-town businessman from Omaha, built his system on the humble acknowledgement that the future is always uncertain. His margin of safety is not an optimization for a specific outcome. It is a survival strategy for all possible outcomes. It is the simple, powerful, and time-tested path to ensuring your financial security in a world that will always defy our attempts to predict it. The principle of margin of safety is not confined to the world of stock picking. Its most powerful and direct financial connection can be found in the realm of corporate strategy, where it manifests as balance sheet strength and creates what we can call corporate anti-fragility. For entrepreneurs and executives, this is the ultimate strategic advantage, a mechanism that not only ensures survival but facilitates a massive transfer of wealth from the weak to the strong during times of crisis. Consider two companies in the same industry, Company A and Company B. Company A, the fragile competitor, is run according to the principles of modern finance. Its management is obsessed with maximizing short-term shareholder returns. It uses a lot of debt, leverage, to finance its growth, believing that a lazy balance sheet with too much cash is inefficient. It buys back its own stock at high prices to boost its earnings per share. It operates with lean inventories and minimal excess capacity to maximize its return on assets. In a stable, growing economy, Company A looks brilliant. Its stock price soars, and its CEO is celebrated on the covers of business magazines. Company B, the anti-fragile competitor, is run like a miniature Berkshire Hathaway. Its management, led by a CEO who is a student of defensive investing, prioritizes long-term resilience over short-term metrics. It operates with very little or no debt. It maintains a large cash reserve on its balance sheet, even though this dilutes its return on equity in the good times. It invests consistently in its brand and in research and development, building a deep competitive moat. Its balance sheet is a fortress. In a stable economy, Company B looks sluggish and overly conservative. Wall Street analysts criticize its inefficient use of capital. Now, a black swan event occurs. A deep recession, a pandemic, a credit crisis. The economy grinds to a halt. For Company A, the situation is catastrophic. Its revenues plummet, but its large interest payments on its debt are still due. It is burning through cash at an alarming rate. Its access to credit is cut off. To survive, it is forced to take desperate measures. It lays off its most valuable employees, slashes its R&D budget, and starts selling off its crown jewel assets at fire sale prices just to raise cash and avoid bankruptcy. For Company B, the crisis is not a threat, it is the opportunity it has been preparing for. Its revenues also decline, but with no debt to service, it can easily weather the storm with its massive cash reserves. It does not need to fire its key people. It can continue to invest in its future. But it does more than just survive. It goes on the offensive. The management sees its fragile competitor Company A collapsing. It uses its cash pile to buy Company A's best assets for pennies on the dollar. It hires away Company A's most talented engineers and salespeople, who are grateful just to have a job. It aggressively markets to Company A's abandoned customers, capturing their market share. The crisis, which nearly destroyed Company A, has made Company B exponentially stronger. It has emerged from the downturn with a larger market share, better assets, and more talented employees, all acquired at bargain prices. This is not a theoretical example. This is the story of how great industrial and financial empires are built. The margin of safety, expressed as a fortress balance sheet, is not merely a defensive tool. It is the most potent offensive weapon a business can have. It is a mechanism for systematically benefiting from the disorder and chaos that cripples more fragile, short-term-oriented competitors. This is the essence of high-level executive decision-making and the core strategy behind the most successful private equity and wealth management firms in the world. They understand that the secret to winning is not just about playing the game well, it's about being the last one standing when the storm passes. You have made it to the end of this journey. You have invested your most valuable asset, your time, into understanding a principle that has underpinned one of the greatest financial success stories in history. Do not underestimate what you have just acquired. The margin of safety is not just an investment technique, it is a complete mental model for navigating a world of uncertainty. It is a tool for making better decisions not just in your portfolio, but in your business and in your life. It is the intellectual shield that protects you from the madness of crowds, the siren song of speculation, and your own worst psychological instincts. You now possess the architectural blueprint for the fortress of financial security. But a fortress, no matter how strong, is only one part of a successful kingdom. A shield, no matter how impenetrable, is useless without a spear. The margin of safety is the ultimate defensive weapon. It tells you when to buy. It protects your capital. It ensures your survival. But it does not tell you what to buy. Warren Buffett's system is a network of interconnected mental models. You have just mastered the principle that allowed him to avoid catastrophe. But this must be paired with the other side of his genius. The principles he uses to identify the truly wonderful businesses. The economic castles with unbreachable moats that are worthy of your capital in the first place. The margin of safety is the how. The video that is now appearing on your screen is the what. It is the next piece of the map. It is the lesson that connects the defensive shield you have just forged with the offensive spear you will need to truly compound your wealth over a lifetime. It is the link that completes the circuit. This is a choice. You can stop here, with a powerful but incomplete tool. Or you can continue your ascent. The click you are about to make is not just about watching another video. It is a declaration. It is a decision to move beyond being just an investor and become an architect of your own financial destiny. For those who are ready to complete their mental arsenal, the blueprint for the spear is waiting. Click on the video and continue the journey.